Alright traders, I'm back again with another video, and today we're going to go over something a little different. We're going to be doing a different trading style, so I want to take time to show it to you. I'm going to go over this pretty quickly, but I'll make some more videos and we'll delve in deeper with this. But right now we'll just get into the basics and show you a few opportunities and how it works. You're going to be using the Williams percent R, and you're going to be using a 100 period moving average. Now I use it on the 4-hour time frame, and I only know how it works on the 4-hour time frame. I tried it on other time frames. I didn't like the way it worked with those parameters, so you may have to change your settings. So I'm not sure about the 100 period moving average if you're going to want to use a 50, or you're going to want to change your Williams percent R to lower settings than what I have it set at. Normally it's set at 14, the parameters for the Williams percent R. Now I'm going to show you how. First of all, the Williams percent R is pretty much like the slow stochastics. This is basically a momentum oscillator. It's going to show you the overbought and oversold areas, and it starts from 0 to negative 100. So it goes from 0 to negative 100, and then I have a 50 line on here, so it's going to be a negative 50 line. I don't know if all charting software has the negative 50 line, but I put that in myself. Some charting software's packages do have it. So you're going to want to have the negative 20, the negative 50, and the negative 80. The negative 20 is going to be your overbought section from 0 to negative 20. That'll be overbought. So here's 0 down to negative 20. That's overbought. Then you come out of you'll come out of the overbought stage, and you'll get in closer to this negative 50. So you'll be pretty much equilibrium, and then the market will drop lower and lower, and then you'll be in negative 80 to negative 100, which would take you to your oversold area from negative 80 to negative 100. Now we don't mind being in the overbought or oversold areas. Most people, when they get in overbought or oversold, they want to look to sell. So I'm going to sell or buy basically. So I'm going to show you how the normal way of using this indicator is, and I'm going to show you where the points are that you would get into the trade. Alright, so I'm going to put some lines on here. So basically, if you're coming from the overbought section territory, and then you cross back over negative 20, you're going to get into a trade here, and you're going to go short, and you're going to get out of the trade when it comes down into the sold area and comes out of it a little bit. So now if you were going long, you would get in right here, just like your stochastics comes up over the negative 80, and then you go long, and you can see what it's doing, and you get out here when it comes back above the overbought and tries to come out. Now we come back out of the overbought section, we will get into the market right here. Okay, and then you go drops down, gets a little bit, comes back up, but then doesn't go all the way back, then comes down. Then we want to go long again, we get in here, and you can see where it is, and it goes and it goes all the way up here. Okay, so that's the normal way you would trade this. Now you're not going to take all these trades. Those are just showing you the ways that it's traded. So if you were looking for shorting opportunities, you would get in on these levels here. So shorting opportunities, those levels, this would be another one right here. See where it's coming out of the overbought section, comes out below the negative 20. That's where you want to get into the market. And then if you're going long, you can see where it comes above the negative 80, and that's where you want to get into the market. So that's the normal way that the Williams percent R is traded. We're not going to trade it exactly like that. We're not going to just get in on those on those rules, or really those signals basically. We're going to get in on we need more of a reason to get into the trade than to just see those signals from the Williams percent R. So at having Williams percent R set at the 50 periods and your 100 period moving average, what you want to see is you want to see price move above the 100 period moving average. The first time it goes above it or below it, that's when you're going to take your trade. But you can only take your trade if your Williams percent R is above or below the negative 50. So if this is above the 100 right here, and Williams percent R is above the 50 level, so we can take this trade. And we wouldn't worry about price being about the indicator being way up and up here in the overbought section. We like to see that. That's what we want. Okay, and you can see how long it can stay overbought for a nice long trend. You know, it doesn't go overbought and then come back down and go down to the oversold section. It stays up here and it's overbought for a while and it trends for a while. And then your trend starts weakening, your overbought starts weakening, the indicator is weakening, and then now you're starting to become oversold. You can see where the market starts weakening. All right, so the thing is, you're going to enter on the break of the 50 and the break of the 100. So you need both of those. You need to be above the negative 50 and above the negative 100 to be going long. And then you're going to put your stop loss below your stop loss wants to be below the 100 on the first candle break, above the first. If you're entering on the first candle above the 100, you want to have your stop loss below the 100 and below that candle. Now if you were entering on a different candle, you would just want to have it below that candle. You really want to try to get it below the 100, but if that's too far, you definitely want to have it below the first candle, a little bit below that candle. Well, not the first candle, but the candle that you entered on. So yeah, you can enter the market on this candle. You could enter the market on this candle. If you entered on this candle, you would want to put your stop loss. I would look at this and at least put it below this level right here. But then the real safe spot is below the 100 right here. But if that's too far of a stop loss, you don't want to do that. And then you could stay in this market until the only reason you're going to get out of the market is going to be, the main reason you're going to get out is if price crosses the 100 period moving average, goes back on the other side. So the reason you got in the market is now changed. So you're going to get out of the market. Or if the price, or if the indicator goes below the negative 50 level, then you're going to get out. So this is speaking in the long term, on a long trade. Now you could also monitor your trade, because see what's going to happen a lot of times, and I'll show you one I know. A lot of times you could get into the market here and then the market goes way down here. So how far would that be? It goes way down here for a good 150, and then you stay in the market because you're following the rules, and you wait and you get out on the close up here. So it would have been right here. Right here you got in, and now right here you're getting out. So what's that? Maybe a couple pips here, right? When actually you could have made 156. So you have to monitor your trade. So what you're going to do is, if price goes all the way down to 150, you may say to yourself, I'm going to let it come all the way back to 75 before I get out. So you would say, well, okay, I'm going to get in here, and then when the market comes back to 75, I'll get out. And so the market came, you see the market right here, 75, you got out. All right, because what you're doing, you're giving the market a chance to get a big run for you. But you could take that 150 profit if you can just say to yourself, I just want that 150, I'm going to get out. Now you're going to have to wait for it to get those same setups before you get into the market. So now you wouldn't get back in a short trade at all here. So you wouldn't get in here, because we're trying to get in on the first break of the 100 period moving average. And that's so we could catch these long runs, these long trends. So if you did monitor that trade and you have a set number that you're going to get out, you're not going to let the market come all the way back from 150 and take you out to 10 pips or negative. So you know, you have to be smarter than that. So if you got in on this level here, so you're getting in here, your stop loss would be above that candle and above the 100. So it's going to be right here. You're not going to wait for the market to come all the way back there after you already went 150. All right. Now here's the real trade that I got into right here. I missed this one right here where the market got in here. The market closed here, and I could have got into the trade right there, but I waited for this candle. This candle closed. This is when I got into the market on the close of this candle. What I liked also was this level right here. This was going to be the previous week's high. We broke that level, so it was great for me to get into a trade here. Now I have my stop loss here. It's still there. I could have moved it up. Could have moved it up to that level, break even, let the market run. It's the weekend right now, and I'm letting the market move because I like the way this is set up, hoping to get a good run, maybe 200-300 pips. But if not, I'm going to monitor my trade. I'm not going to let 81 pips right here that you see I made come back to zero. So what I may do, I may let 81 come back to 40, maybe 35, or I'm going to decide a number where I'm definitely going to take a profit and know that the market's starting to go against me. Okay, but if I follow my rules, now I'm going to wait for either price to come back to the close below the 100 period moving average, or for this indicator to close below this 50 level, this negative 50 level. All right, those are the rules I'm going to wait for, and after that I'm out of the trade, and then I go look at some other pairs and I find the same setup. Okay, and basically you can look at your pairs and mark down which ones that are going to be close or waiting for. And what I do have, I have an indicator, I have an alert that's going to alert me when any price touches a 100 period moving average. So whichever pair touches the 100 period moving average, it will alert me to that pair touching that level, and then I can start to look at that pair and see if I have any opportunities. Now you're going to say, yeah, this is going to whipsaw you a lot. Okay, see, I have the settings. I use this on this settings, and I tried it on other settings, and I wanted to show you that some of the things that are going to happen is the way that it's set up, and the settings are going to help you to not get into certain trades. Okay, and I want to find some for you, like this one here. Okay, so you would have said, okay, I'm going to go long on this, but you can't go long on this because your yeah, price is above the 100, but the indicator is below the 50, so that would have kept you from getting into this bad trade here. Now you would have got in here. This was the one that I showed you. And then see here, you break this. This is the same thing. You get in. And then back here, you got in here. And see, this was a little trade. And it wasn't a loss. It still was a profit of 70 pips or so. So you know that you're not going to let 70 come back to zero and then take you out for negative. So maybe you say 70, I'm going to let 70 come back to 25, and at 25 I'm out. Okay, so that trade didn't run for you like you wanted it to. And then you get in the market here, you could see we're below, so we can get in. We put our stop loss up here if you want to be a little bit safe. I mean, you can put your stop loss just a little bit above the 100 period moving average, or you could put it above the candle all the way, so it'll be a deeper stop loss. But then you see price came down. It wasn't a big run, but it still made some profit for you. So it went down and roughly went about 170. Yeah, so that's not too bad. But then it came back out and it stopped you out. It would have taken you out right here. So you wouldn't have made that 170. It would have been way less. But like I said, you're not going to let 170 come back to zero. So maybe 170, you say, I'm going to let 170 come back to whatever, maybe 80, maybe half of it, something like that. So that's how you have to monitor your trade, because you want to give the trade a chance to make that big run, and you know that the market's going to retrace at times. So on the retrace, you want to give it a chance to retrace and give you room. But if you see it coming back too far on you, you say you're going to get out. Okay, so let's look at another trade that could have happened. Alright, so this level broke, but it wasn't ready yet, because even though price was underneath the 100 period moving average here, let me move this up closer for you guys to see. Even though price is under the 100 period moving average, the indicator didn't close under that 50 level, so we need that to happen. Now we're here, that's close. It pretty much closed below, and you probably would have got stopped out here because it came back a little bit, but you wouldn't have lost much there. And now and you're not going to go long here. You're closing right on the line here, so just wait. It's too close. But then here you close below the 100 period moving average and the indicator 50 level. Now the thing is, you could see the 100 period moving average is flat, so that's where you get whipsawed, and that could happen. But see, this happened here was you got a good trade. So this, you got your rules, and it came down and continued to roll. You would have followed this all the way down. Now see, this went down to from here to roughly here, That's like 430. You're not going to let 430 come back to zero, right? So you monitored your trade. 430 came back to this level, but you still were in the trade, and it dropped even farther. So 430, let's see, we got in here, and then we say 430, then we came all the way back. This was roughly about 270. So from 430 to 270, some people may have gotten out, and you've probably been smart to take that 400. I mean, once you get up a certain level, you're gonna say, I'm taking that. You get to 400, you basically might as well take that. That's really great trade. Okay. But even though the trade continued to move, and you could have probably made close to 500 pips on this trade before price came and jumped out, you would have got out right here. Well, basically right here on the close of this candle above this 50 level. Price still was underneath the 100, but we closed above this level here. This is telling me the momentum is becoming stronger, and it's to the upside, and it's becoming closer to an overbought stage. So more buying is going on. So we need to get out of that market when we're already short. So do you understand that? That's the basic things what we're going to be doing. And really that's all I'm going to show you for now. And you could see all this here. We'll go over this real quick because I think this is where I wanted to show you guys where you could get whipsawed, but some of the things are going to help you to stay out are going to be like, okay, you get into the market here. This would have lost, it would have been a losing trade. Yeah, you would have made a couple pips up here, but it would have came back and taken you out. Short loss because look how close we are. All right, so then there's nothing going on yet. You can't get in on a red candle close, and anyway it was above the 100 period. So you get in here. All right, and then this would have been a loss. If you might not want to even take it, considering how far away it is from the 100 period moving average, and the 100 period moving average is pointing downwards. But if we look at price, we could see it kind of flattened out. Now it takes the 100 period moving average some time to catch up with the price and roll over, but you can see what price is doing, and it's starting to slowly move upwards. All right, so looking at a short opportunity, you got to look at price action also. Price action looks like we're starting to have a trend upwards, so we want to catch that trend, that trade up. And so if we got into the market on this one, you would have made a little bit, and then the market would have came back and taken you out. So it wouldn't have been really a loss. Now here you get into the market, you could got in here, and then this would have been a little profit, but then the market came back. So you could see all these levels where you say that it's going to whipsaw you. Sometimes you're not even going to be able to get into a trade because you don't have both of your rules met. Okay, but then finally this was that trade that I just showed you. So yeah, that's how we trade this. I mean, I'll come back with some more videos and show you about this and how to trade it. There's going to be other ways to trade it where you could see this bounce here. There's going to be some bounces off of the 50 that we could trade, but those have to be on certain levels. You can bounce off of the 100 period moving average level, or you can bounce off of a support and resistance level off of a 50. And sometimes you're going to use your Fibonacci retracement levels. You're going to put those fibs in, and you're going to have a bounce at the 50 level of the Fibonacci retracement, and also at the 50 level of this indicator. I'll show you those eventually. We'll get into that. We just wanted to start showing you the easy part of the trade, how to do it and how to trade this. So look for those opportunities, and that's how you trade this. All right, so Williams percent R with the 100 period moving average set at 4-hour time frame. All right, traders, hopefully this is helping you guys. If you have any questions, just let me know. Try this out on your demo account and see how you like it. Follow the rules. Don't be so quick to just jump in a trade. Use all the rules. Don't say, well, I have it over the 100, but it's not quite yet over that 50 on the Williams percent R. Yeah, that means don't get into the trade. All right, so just wait, follow the rules, and then see how it works for you. Your stop losses are going to be basically pretty tight because you're getting it on the first break of that 50. I mean of that 100 period moving average. So you're going to be pretty close to that level. All right, unless you get a big candle that breaks way above that level, then I probably wouldn't even get into the trade then myself. All right, traders, so we'll go over this again. I'll have more videos. I'll make more videos of it, and we'll work at it. All right, traders, until next time, hope I'm helping you, and God bless. So long.